There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Inflation data in focus is sort of my little beginning monologue, if you will. So the August Consumer Price Index, which will be out Tuesday at 8:30, and this is Eastern Time, where we are obviously broadcasting here from our HQ in Orlando, is the last big economic report before the Federal Reserve meets on September 20th, 21st, essentially the third week of September. So expectations have firmed up for a third straight 75 basis point rate hike. It stinks to say that unless you're somebody that likes having your money in money markets, in which case you've been cheering for the last part of the summer because they're paying a lot more interest on cash and money market accounts now, obviously. But if it's the third straight 75 basis point rate hike, it's still an if. They could go 50 basis points. A soft inflation reading could certainly bring that. But really the odds are against the Fed hiking all the way to 4% early next year if a soft reading comes in. So after prices were unchanged essentially in July versus June, the August CPI is expected to see another flat reading, may even be negative. So if it is negative, I just don't see us getting to 4%, right? And really thanks to falling gas prices and a couple of other commodities as well. But focus will really be on the core CPI, which slowed to a 0.3% monthly gain in July. So this is a great example of why always know what metrics you are being presented from the financial media. That is not a clickbait begetting headline, right? That is a boring headline. Which is much better headline is inflation up a ton over the last year, right? It certainly is a big clickbait-based inflation getter if you're reading that, right? But the market's already priced all that in. So why on earth do we care what the gain is last year over this year? I mean, if you're a politician up for re-election, obviously that is more important to you than month to month. But as a trader or a portfolio or anybody who runs money or trades essentially any type of instrument, the most important thing is what the news is down the road, not looking in the rearview mirror. We can learn from what we see in the rearview mirror, but as many know, unless you're a stunt guy, it is driving incredibly fast and reverse is difficult to do. So let's take a look at the news next week. Remember, always make the mistake that I was just about to make, right? Click to the next week. So in any case, not that we care about anything that goes on in China unless it spills over into this country now, right? I tell you, we were surprised to find out there was my wife and daughter purchase, a bunch of clothes online, like a lot of people do. And they had learned a couple of the retailers that they were purchasing from were 100% Chinese owned and probably manipulated by the government. So needless to say, my daughter was a little bummed out that she is basically instructed by us to stop buying from that website. Any case, Monday. So we got GDP coming out. Obviously, you want to pay attention to any GDP ratings, as because they are sort of like the, I don't know, the secondary reading. Used to be jobs, right? Doesn't really necessarily matter. But in the inflation front, it would matter if jobs started, or I should say, job growth started heating up dramatically, right? Which isn't really happening. But the CPI reading is really the key. This is basically it. So the Fed is 100% pivoting off of what you see highlighted in green on the screen. It's really the bottom line. I don't think you need to delve into these numbers as much. You're certainly welcome to click on any of these and read further. Really, the key is we want to see inflation cool. If it cools a lot, okay, I can tell you Wednesday and Thursday, do not be short the U.S. markets, okay? Because they will rip, right? They may even rip all day Tuesday if that in fact is the case. If it does not look good, or let's say inflation continues to creep higher, which I don't think is going to happen, but who knows? That's when it gets tricky. So whether you're trading currencies or currencies via MT4, MT5 on indexes, right? Or you're trading some sort of index based, or you're trading options, equities, what have you, certainly the futures markets. I don't really think that the first piece of advice I give you is difficult, right? A cooled out reading or a much less inflationary reading on Tuesday in the morning news rips the markets. I think the concern is if it's flat or higher, because then you're like, well, is it priced in? Are all trading bets off the table, right? A lot of people see these really just face rip dead cat bounces, and I'm speaking more specifically the S&P 500. Here is the daily chart. I'm speaking really to, actually forget that. Sometimes I hate looking at these ads. Let me show this full screen. So let's just take a look at the S&P, just the index itself, no futures markets, right? So here is the daily chart of the S&P. What oftentimes happens in bear markets, and one can say, well, we're in a bull market. Forget about where you think the markets are. Remember, I said trade what's in front of you, not what you think it's going to be, right? So since the high of approximately 4,800 here at the top, we have had 1, 2, 3 successive lowers, 1 successive or 1 fractal high on this movement, right? This was, in my opinion, a dead cat bounce. It was fairy tale based upon the fact that inflation wasn't going to be that bad and the Fed was going to pivot, right? You heard that term a lot, right? So you had just a ripper, and reality sets in, right? This is what I talked about on Tuesday, my Tuesday cast. Jerome Powell, under no uncertain terms, basically said, unless inflation cools, expect 75 coming after each meeting, right? And that could really be an issue as far as going forward. But we pulled back from that point significantly, and now we had a couple of face rippers. So we can actually count Friday as a one-time framing higher day one. And the important thing about that is that will it set a tone? Will we continue to trade higher, meaning you're out of the previous day's high, you're above the previous day's high. You don't even get into the previous day's candle as far as movement or any type of auctioning, right? So we're one time framing higher. So now really the question is do we continue to rip higher? And I think on Monday, we'll probably see a doji or an inside day candle from Friday. I would expect that because we're really waiting the Tuesday morning news, right? So a few times in one's life, there are events that absolutely take precedent. And in terms of trading in the markets, there are even fewer times where just a simple reading is really everything. It's almost like you don't even need to worry about the jobs numbers, although they will factor in. There'll certainly be people out there much smarter than I that will argue with me on that one, but all the market cares about is inflation readings. So if inflation readings come way down, what happens? Federal Reserve stop raising interest rates, right? Cost of capital does not become costlier. Thus, you have to ask, is it already priced in? So, at one point, down in this range here towards the lows, we were 1,000 points off the high of the S&P. So essentially, a little less than a quarter of the index was cut off in valuation, right? It's pretty heavy cut for potential slowdown in the economy, but outside of one's own political affiliations or aspirations or anything that is coming out of policymakers, just purely looking at price action on this chart, we can ascertain that we'll probably spend some time trading inside unless some other news breaks. And then, no, I mean, all bets are off after Tuesday. Like, I have no idea what the direction will be, right? I can only tell you from the perspective of auction market theory is down here at this 3720 area, which is far away. We have a whole bunch of missing notches, meaning that it was an incomplete auction process, which historically will always go back down and complete. Question is when, right? It could be 2 years from now we get back down to this area. I mean, I just don't know. A lot of it's just going to be based upon, but do understand that when I talk about missing notches or incomplete auctions, and this could be on any chart, it could be the US dollar versus the pound, obviously there can be missing notches. The efficient market, if one can, with blanketed certainty, if one could agree that make up the currency, Euro US dollar was an efficient market, right? If everybody could agree on that, and that's a big if. Obviously the S&P ES futures is probably a better place that most institutional participants would agree it is an efficient market, right? Meaning that it typically trades as it should, right? All known information being priced into the market, right? That's modern portfolio theory for those of you that want to take a deeper dive. But if one could, with a relative comfort, all agree that it is an efficient market, then the parameters or some of what I talk about in missing notches or incomplete or an unfinished auction will always go down and fulfill itself. So, and that is my weekend ramblings on the market profile front. So let's take a look at the news. All right, so consumer price, PPI, both of those components will carry weight as the US, right? So essentially the CPI, you're looking for anything. This one's a year over year figure though. So this one's a month over month, carries a lot more weight right now than year over year figures, which are mostly known, right? So anything that's related to CPI month over month, I pay much more attention to this going forward than I do anything. It's not like they don't matter as far as red folder events, they just carry less weight. The best traders planet-wise, whatever market you're trading, I don't care, will assign weights to different news events. But they will always, at least I hope, employ the concept of Kaizen, right? Always be flexible, always be willing to change, and don't have hard and steadfast. It's not like you'd change your analysis of a particular chart pattern, right? But you would at least have the flexibility to entertain ideas that, well, maybe that's not a double top or a double bottom, right? Maybe it is a spinning or an island reversal or a hammer, right? So just be willing and open to flexibility in theory, right? That's the understanding that, always willing essentially to be better. So that's a key component to risk management. Many of the, let's just call it stubbornness, right? And it isn't necessarily, in a lack of intellect or intelligence, but stubbornness can absolutely take over in risk management in your unflexible ability to look past a particular opinion, right? So if you ever meet people, especially at a cocktail party, this is always a great exercise. You'll meet somebody that is just so opinionated on one thing. They may be an expert on it, but it's rare. You usually just have the loonies that just take such a hard and steadfast opinion, right? A lot of the environmentalist crazies are a great example of this. And you ask them a simple question about a core component of the climate, they don't know the answer to it, right? So if you ever come across somebody, and this really isn't to point out the left versus the right, right? I mean, there's nuts everywhere, right? Especially these days. I just choose to associate myself not only at the company with my partners and our employees, um, but all the students I've taught over the years, and folks that are willing to be coached, right? That sort of ability to be moldable. Believe it or not, that is a huge component to risk management. So if somebody ever said, "Hey, I want you to write a book," which I've been asked to do, I probably would just have to hire some ghostwriter because I suck at writing. But the concept of risk management permeates everything in one's life, right? And your lack of ability to sort of see the forest through the trees, right? You've heard that term before, or one's an unflexibility, right? Or a lack of kaizen is a real issue. So I would say in your growth as a person, and in your growth, certainly from the educational standpoint as a trader or any kind of portfolio management or allocator, or a whatever type of manager you want to be flexible. It's really that simple. And take advice from people that know what they're talking about in most cases, which certainly isn't me in all of these situations, because we always want to carry the humility that we can and oftentimes are wrong. So with all this negative talk today, hey, maybe you guys learned something. All right, so that's kind of it for, that's really all I want to say there. I'm going to skip past this because I talked a lot about that on Tuesday. Let's just talk again about some macro forces building up for those that care to. That is my Twitter account at FXESTrader. Most of what I do is retweets. Why? Because many of the people I retweet are far smarter than I, and they have done many, many levels deep of research on subjects. Sentiment Trader is a great example. This guy has a huge following because of some of the stuff he points out. Most of this is just big picture macro stuff, right? That's more or less, in his case, a comparison to historical stuff. So just talking about, and for those of you that track equity-based indexes in whatever form, this is obviously more on your particular path, as I have a tendency to include in this analysis a heavy focus on equities, because more and more, a lot of the Auvoria traders I follow are trading index-based stuff, right? Whether it's in the options market or certainly currencies via MT4, or I should say via MT4. All right, so last week, institutional traders bought a whole bunch of put options. And that means that they were betting on the downside, right? They bought less than $1 billion in calls, and they bought $8 billion worth of puts. So this is 3 times more extreme than this. The problem with this type of posting is if one does not have the context. And by the way, guys, I always, especially when it comes to Twitter, stay away from clicking on this and reading the comments, because all it's going to do is just cloud your brain, right? Because you have no way of knowing the people that have replied unless they are, a good follower well, right? And there are people that occasionally comment on, some of the best stuff, but I would caution you to pay no attention to any of the comments that come in here, right? Unless this person's sort of a verifiable, smart, good guy, gal in Twitter land, right? Which is rare. Most of them don't comment on other people's posts. So I always just stick to the post itself. As I am, and my kids will tell you this, I absolutely abhor. There's a word if you're not sure what it is, look it up. I abhor any type of comments-based chitter-chatter because it does nothing for us other than turn our teenage daughters into basket cases, right? So I do not allow it in this house. I do not. My kids would thank God they give a rat's ass about Instagram and all the other services. They just don't care. So, and I think that's great because you want to get your kids away from this stuff because it is just toxic, right? And it absolutely can interfere with one's risk management, right? So, focus on people that know their stuff, right? Most of these people are far smarter than I. This is 3 times more extreme. The problem with this from a context standpoint is that we don't know what the expiration of these call options are or these puts, right? So many of these could have expirations way out, right? They could be leaps, which essentially is just options expiring next year, right? Or in some cases 2 years, which is rare. But leaps-based options have much longer time expiries, which means that most of the Greeks, which is just all the algorithms that affect them from gamma, delta, all that fun stuff, which is just analysis of options, can be completely skewed out. So, but it is of note. So, what these types of things, what you can surmise from this type of post is that something crazy is probably going to happen, right? But here's the problem: we don't know when it's going to happen. So it's like, well, gee, Steve, why the hell did you even bring that up? Well, my job here is to warn you of things. The problem is that warning that goes out, as I have done many times in the last 2 years at the helm here, never turned into truly a black swan event, did it? So take it with a grain of salt. In this particular case, though, this absolutely could affect the trading of any index on MT4, right? Or obviously the markets as a whole, because this is just the entire options markets. This is on stocks, this is on ETFs, this is on indexes. I mean, it is of a broad array of purchases. It's not just short-term options that expire in October, right? Or November. Although I would believe probably a pretty good chunk of these will be expiring in November. But it's a hell of a shot in panic hedging. So many of these related to the real estate market. You guys have seen me post. I try hard to only post stuff that's relevant. I can promise you, probably one of the more unbiased people that I get a fair amount of research from, mostly just big macro stuff and comparison-based data. It's from Charlie Bailello. This kid's won a whole piss load of awards. He's a razor sharp kid, and this kid is just a data geek. He loves it. So he tears his stuff apart and dices it up 6 ways to Sunday and presents it in different forms. So anything he posts, what's called Compound Advisor, that's his blog. It's good stuff to pay attention to. So the rate at which the 30-year fixed mortgage rates have ripped has been huge, right? It's essentially taken us all the way back to where rates were in 08, which was approximately 14 years ago, right? So now the rates are back up at that point. What does that mean? Well, it typically means that the demand for real estate is about to fall off a cliff. In the more speculative areas, it will probably be first. So as I sort of joke with my family and guys at the office, they get a kick out of when I always bring these comments up because we're hunting for a house. So obviously, we want real estate prices to crash, right? But outside of that, let's take a look at what else. I talked about this on Tuesday. It's actually really good stuff. If you guys want to take a look, it's almost like a little Khan Academy type class and understanding the basics of spreadsheets as a business. I think it is important for anybody to know if they want to be an entrepreneur. That is it for Twitter. Let's go into the charts. We've already talked about S&P. After Tuesday, I really have no clue. Can't give you guys any direction there. Let's jump into currency land. So, put things in perspective. If you did not see my cast Let me shift back to all data, reset the scale. If you did not know, TradingView, at least on this data, has brought a lot more historical data back into the fold. Why? Because we have to use it. Here's the problem with old price structure, right? Doesn't mean crap. All it does mean is that at certain levels, you will probably see a reaction, right? Only from the standpoint that, hey, it was the all-time high in 1986, right? So there'll usually be a reaction off of that. Where you go from there has really nothing to do with where price traded in 1986. That's all I'm going to say on the subject. It's risk management. Don't get caught up in it. Don't put too much time in prices. Nobody's holding currencies from 1986, right? In terms of institutional portfolios. So it's not like there's, hey, these guys bought it 35 years ago. They're going to be back defending this position higher or lower, right? It just doesn't matter. But I do think that, as I've talked before, this 120 area, depending on where inflation goes globally, I think we've still got a target on its head for this area. So in the face of no data that gives us any clarity one way or the other as far as where central bank's going to head globally, right? This is the area with target. When, where, how long does it stay there? I have no idea. In the meantime, do pay attention to the more relevant stuff. Let me just drop back to a daily. Actually, you know what? Let me expand this again. I didn't like those lines on the all data. This one's cleaner from a daily perspective. This is probably also the center point or POC of the whole trading area up here. So 109 perfectly. Lower point, basically 105. Could stay within this range. Notice we had a rejection off of this area. We finished above it. What does that mean going forward this week? Well, Monday, it's about the only day I'd have any confidence in any of my trading forecasts today. Just Tuesday, all bets are off, right? So, and honestly, Tuesday, I'll tell you, if it's something that's a really outside of the box number, for those who want to stay on sort of the safety side of the field, right? First down, get the joke. Want to stay on the safe side of the field or want to get that first down trading, I would stay away from the volatility that's probably going to ensue for hours after this plays out, right? Unless we have some whip reaction and then we just start a trend, which could absolutely happen, right? As I actually have a couple of videos, I think up from the old days up on YouTube about that, but we used to trade the Federal Reserve decisions. That's not something I would ever present in an event like this, because you have to take the opposite of the opposite of the opposite reaction and go with the first breakout trend, but we're willing to just bail at a second's notice. I mean, it is just not for the faint of heart, right? It's like those chili eating contests where everybody's like, yeah, I can eat the hottest stuff, right? And they slide these chili peppers in front of these guys and they go down after the first bite, right? So it's just not something I would teach, but I can promise you, if it is outside of some of the norm parameters we've been talking about as far as those consumer inflation rates, it's going to be wild. Euro US dollar, the opposite of what I just said. Okay. Support down here, basically at parity. And maybe about 70 pips lower than that. So support right here. Although I thought this was interesting. They came right back up to these perfect and just dropped. Look at that. And I mean, yeah. So where's resistance? Almost perfectly $1. Isn't that crazy? Just bust out those old movie lines. Seth Green. For you, $1. Hey, how much is this? $1. You guys haven't seen the movie, you can Google it. It's hilarious. um, They don't have much more to say there. How about that? Stevie with his tongue tied. Shocking. British pound. Let's take a look at this as well. So, I guess I could say from all of us here at Auvoria, we do wish the Queen Elizabeth the hopefully ability to rest in peace eternally. This is a big deal for everybody in Europe, certainly in the UK and England more. So our sympathies go out, but just understand that historically, I can promise you that lady will never be forgotten. So, with the unfortunateness that outside of Russia, as I'd mentioned on Tuesday, the British economy is, from a global perspective, probably number two, and it's in the crapperness. And a lot of that is due with just high inflation, right? So numbers are a lot higher in the US, probably in some cases 30% higher, right? So that's why you've seen just such tremendous weakness in the pound, which is typically holding up historically fairly solid, with the exception of George Soros breaking the Bank of England in 1992. It's held pretty solid um, in the face of adversity, but man, not this year. I just wouldn't be against it, honestly. At some point, if the dollar just completely sinks out and we have some sort of slingshot, which would be the first solid one in this entire chart, basically from a daily perspective, this 1.1760 area will be resistance on the upside. Back inside a very long sideways trade. See that? Picking the highs and lows. Just now it's back inside. It's because of the weakness, obviously, in the dollar, but not a lot to be gleaned from that. Typically, when something tries to break out of a very large balance area, which is what this area is, right, and it falls back inside it, just know this: a lot of times it'll trade right back down to the bottom, right? Failed auction. So what does that typically tell you? If it's a failed auction there, it's going to auction all the way down to the other side. When, where, how long? Don't know. Just know that that's typically what price action does. Doesn't necessarily mean that's going to happen this time. We've got a fairly solid bunch of strength, including a center point you see here, right? That's this red POC line. And this has been calculated from all of the data since we've been up in this range. So even if I take the data back, I'm just sort of scrunching the chart up because I want to continue to bring all of the volume data in, right, over the whole period of time. This is over a year here. So if we're bringing all data in, the center point right there is 2822. See that? Be the first target I think we'd go for is that. This is where most of the volume executed in this major. See that? In a big way. The only problem, as I've seemed like a broken record on, but we constantly have newer subscribers that have never listened to me before, so I will always say this. The problem I've always had with currencies is that I can't, with a reasonable certainty, right? Now, the guys at FXTM would probably hear, and I've heard they've caught some of these cats, been kind of pissed, but tough. Because the issue, at least with me, right? Call it, hey, Steve, it's your own crazy world. But the issue is always the quality of data that has come in from the exchange. I find it to be manipulated, but I'm happy to be proven wrong, right? So some of the smartest guys out there that I know, including Dasan, who is the developer a variable. It's actually become a friend of mine. We go out a fair amount here in Orlando. He's pretty comfortable with the data. So I mean, his opinion carries some weight with me because I could tell you many of these indicators that I have on here were actually built by him. So I don't know. Maybe I need to get off my horse, right, on that. But if I could be 100% comfortable that the data was aggregated and solid, right, these would carry a heck of a lot more weights with me in discussion, right? Like I would tell you, for instance, if that was in fact the case, maybe I should just make that the case, right? This 2.822 area would probably be the first area we head towards if weakness continues with the dollar, right? This is not an area that can be picked up or nailed, if you will, or crosshaired into from any other type of technical indicator other than an aggregate of trading volume. See that? See how this particular candle, I guess it'd probably be easier to see if they were bigger, huh, Steve? Now I've changed the data, so whatever. So this bar that you see here is market profile. It's an aggregate of all the volume executed at a particular price over time. Okay, this carries just, if not a lot more weight than anything else on this chart. So I talk about it. I don't talk about it enough because I don't want people relying on it solely. But in ES land or any active futures contract, of which NQ and ES I find to be the only two that fit that parameter, active and a aggregated trade, right? It's all one on centralized exchange CME. These you could trade just off of a market profile chart on any time frame. I don't care if it's 2 minutes, right? If you just had candles, you had nothing else, and a market profile lines on the left-hand side, you could set these up left, right, wherever. You can aggregate them on just a group of candles, whatever. It's all kinds of stuff you can do. You don't have a lot of that flexibility with TradingView, but if you moved into other types of software like LinSoft's IRT, which is my preferred in this area, but I know some of the Sierra chart guys say you can do the same stuff. I just haven't looked at it. Whatever. I prefer LinSoft, which I run on my systems in the office. And it gives you really, really good aggregated data of where all the executions are. And so why does this matter in the grand scheme of things? Well, I'd much rather trade based on data of where everybody else bought and sold, right? And if you can aggregate where everybody else bought and sold, and it was good data, right? And it was solid off of a centralized exchange, you have some of the most strongest based trading data out there, period. Why? Because it tells you where everybody bought and sold, right? So if you could just aggregate that, put it on a bell curve, right? In this particular case, it is not a horizontal, but a vertical bell curve. You can understand the data. It's very powerful. So, as I seem to continually get away from the currency discussion, that's okay. I want you guys to understand. So, the meltdown in Japan continues, although we had a nice little reversal here. That's because of the dollar pullback. Here's the dollar yen chart. Not going too much into that. I'm going to click on these other ones, so pay close attention if you want to see your other currency. These are all daily charts. We are not getting into any detail on these. I will just be clicking on them. You can see where the levels are. You can always freeze this video if you're watching recording and make note if you need. Surprise there, huh? Euro yen, Euro CAD, Onanda. These guys kill me. Euro, your Australian dollar. There's GBP CAD. No surprise in any of this British-based stuff where the currency is front The weakness has been there. Obviously not on this one because it is the yen. The down under countries to each other. Let's go into gold. Spot price. Probably need to reset the scale. Why did that disappear? Right. This is it right here, guys. Anybody trading gold? 1680s I've talked about for over a year is the edge of the cliff. If we get underneath this level, I can promise you there will be an extended move lower, which almost, in my opinion, may be worth a buy. They're looking to add gold to the portfolio. I would not make this anything more than about 2% of your portfolio at this point, maybe 3. There are a lot of people I meet out there. Sorry about the yawn. There are a lot of people I meet out there that have excessive amounts of gold. Many of these people are very wealthy, so they can, but many of these people are of the cut of the cloth as the world is sort of raped and pillaged, right? It's just most of these preppers think the end of the world's coming. That gold will be the standard and the only standard of which you can use to trade and barter for other goods and services, right? It's like back to the Stone Age stuff. So if in fact you fall into that parameter, I can't help you. But from just a normal risk management portfolio manager saying, that is the percentage I would have as your allocation, just like any other stock or bond. But if the numbers are really not good next week, I can promise you those in bonds will continue to feel more pain. Actually, you know what I should probably do on that respect? Let's go take a look at some credit charts. iShares 20 TLT is one of the most recognized in this arena. To a lesser degree, I don't really show the Russell too much, do I? So let me just show this unfortunate chart. Part of this is what mortgage rates are based off of as well. So just know that as price falls, right, yield goes up, right? Why do prices of bonds fall while interest rates are increasing? It's very simply because if Johnny has a bond paying him 3% and new bonds come out at 3.5%, what bonds do everybody want? They want the ones at 3.5, right? So what's happening to the price of Johnny's bonds? They go down. This chart absolutely sucks for anybody that's looking to buy a house. I mean, like, seriously sucks. So your cost of capital essentially has gone from about $150 higher per 100 grand you borrow. So if you're buying an $800,000 house, your cost of capital on that mortgage purchase is now a lot higher, to the point where many people are priced out of a decent house, which in most of the areas of this country, you got to spend about $450 and up to get a decent house, right? So I have droned on for quite a period of time. I think I've covered everything for you guys. Hopefully you know what to look out. If you have any questions or you want to make any suggestions to improve this broadcast, hit me up on Telegram. Maybe one of these days I'll have a chat-based Discord room, which I have told Bill Wynn and the guys at Run Auvoria, don't turn it on for me yet because I'm not monitoring it. So With that, I'll bid everybody a great week. I wish you much trading success, but as always, risk management can make all the difference. Steve Vetterl, wishing you a great weekend. Off the mic.